Okay. Okay, so this is the last bit of the day. We finish the background of Solvency II. If we have time, we can start with the quantitative requirements, the quantitative aspects of Solvency II. So we were here in these slides. I was telling you about the quantitative impact studies that were conducted in Europe, basically to test whether the Solvency II was basically a standard that made sense, that was reasonable, and moreover, whether the parameters of the standard formula were rightly calibrated. Okay. Now, what is the standard formula? The standard formula is not one mathematical formula. The standard formula is a procedure, right? So it's a collection of hundreds and hundreds of formulas and factors. And so the regulator basically decided, well, if you want to use the standard formula, then follow all these procedures, and many of them are very complex. Or you can also use your own model, and if you use your own model, it's called an internal model, and this internal model you are free to do basically whatever type of modeling you want. And I think the idea is that if you use an internal model, you may have a lower capital requirement than if you use the standard formula. But then companies have to decide whether it's worth developing an internal model. Now, I know of a reinsurer, large one, French one, one of the largest in the world, that took 10 years to develop their internal model. And they will tell you that, right? They are very proud of their internal model. Now, this French reinsurer does business everywhere in the world. Reinsurance is a business that is very, very international, very global, right? So they are all over the world, and of course they have exposures everywhere. And what reinsurers do on occasion is that they swap risks. So, for example, there's a lot of risk concentration in Japan because they have earthquakes, and there's a lot of risk concentration in the United States because they have hurricanes. So reinsurers swap risks so that they have some exposures in Japan, some exposures in the U.S., which are the largest markets in terms of natural catastrophes. Okay, so that would be basically an incentive to develop an internal model where you are so big that maybe you can derive some benefits, you can gain some advantages by having this internal model. If not, just follow the standard formula. We are going to see the standard formula, some aspects of it, and but the general idea is that either you follow the standard formula or you follow an internal model. Okay, so you have to calculate a minimum capital and a solvency capital. All right. So the minimum capital is a capital that allows you to keep operating without insurance intervention. But then if you are below the minimum capital, then you can no longer sell business, and then the regulator basically is intervening the company, basically taking care of runoff activities and things like that. Okay. So this is pretty much how it evolved. Now let's talk about insurance supervisions. Okay. So you have the G20, used to be the G7 the G10, G10 in 1974. Then a few years back it was the G7, then the G8, right? Now it's called the G20 because in G20 you want also countries like Brazil, like India, like Turkey, like Mexico, like the biggest 20 economies in the world. All right, so they have the political authority. Then this G20, and G20 really, G stands for group of 20, and basically this is not a legal entity. This is not a legal association. This is like a club, right? and the heads of state of the 20 largest economies in the world get together, and also the finance ministers and the central bank, the heads of the central banks and etc. get together, and basically they, a few years ago, and actually this was right after the financial crisis in 2007, 2008, they created a board called FSB, Financial Stability Board, with the idea to avoid further liquidity crisis and credit crisis that hit the whole world in 2007, right? So they said, what do we need to do to avoid this? And they separated the world into basically three types of industries: the banking industry, the insurance industry, and also the asset management industry. Okay, and then for the insurance, right? For the insurance, basically they went to the International Association of Insurance Supervisors, right? So the International Association of Insurance Supervisors, IAIS, it's based in Basel, Switzerland, right? And it's actually it's based in the same building that I showed you, where the Bank of International Settlements is. So this is the International Association, and this is a body that is basically SUSEP is member, INS is member of this IAIS, and they have about more than 151 members. Okay, so that's why I put the two Brazilian regulatory bodies there, because both are members of the IAIS. The US has 56 members, right? Because I think I told you yesterday that they have regulator by state, and there are 50 states plus Puerto Rico and U.S. Virgin Islands and Guam and all the rest, right? So there's 56 jurisdictions, and then there's IOPA. IOPA is the what I call the super regulator in Europe. So all in all, there's a list of 151 members of IAIS, and what they have done is to publish these so-called ICPs. ICP means Insurance Core Principles. So, and the insurance core principle is, what are the principles of regulation and supervision across the world? And then there's a lot of workshops and seminars and training. So the more developed countries are also through regulation transferring some knowledge to the emerging countries and so on. And they have developed standards of solvency capital, which are basically very consistent all across the world. IOPA is responsible, like I said, for Solvency II. The US has a different solvency system. It's not nothing like Solvency II. Actually, the US was very advanced in solvency matters, but since a few years ago, it's Europe who is really at the forefront of solvency developments. Okay, so the principles of insurance supervision and regulation are available at the IAIS website. I can tell you where to look, and everything is downloadable. So you can look at what are these solvency standards of solvency capital. They adopt the so-called balance sheet approach. And the balance sheet approach is basically to look at the market value of the assets and the fair value of the liabilities, like we are basically like we have been doing for our cash flows in IFRS 17. The assessment of everything, all the relevant risks. So it's not only in the Solvency I world, there was a factor multiplying the premium, and that's the risk, right? In the standards of the IAIS, the idea is to measure all possible risks like market risk, credit risk, operational risk, and so on and so forth. Then to maintain the solvency levels, control levels, and then what they say is that there should be two control levels. One is the minimum capital, and the other is the solvency capital. So like solvency capital is the target capital that you need to operate, right? And which is not to be confused with the capital that like the social capital that you need, that you are required to open a business. Okay, so the solvency capital basically is the capital that should be set aside because we are in a business that is uncertain. All right, so if there are big losses, then my capital base could suffer. So I need to have certain margin, and I'm going to talk later about capital, right? And also the IAIS has standards for disclosure. What needs to be disclosure to the authorities, right? Which changes from jurisdiction to jurisdiction, but many jurisdictions are adopting the same type of ideas. So the Brazilian solvency, what I have seen has some elements of Solvency II, right? Is in some respects similar. In some other respects is different. The Mexican solvency is originally was very close to Solvency II and to the Swiss solvency test, but then today is a different story. It's a different thing. Mexico was one of the first countries to adopt a Solvency II type regime. It's not Solvency II, it's Mexican solvency. And between you and I, is not working very well. They have a lot of problems, and I will mention a couple of things that are not working well later on. So Mexico tried to, I don't know, in some way tried to be ahead of the pack for whatever reason, and it turned out that it was very complex, and companies right now are struggling. They are finding too many difficulties. The regulator is also in trouble, and all the rest. Okay, so this is the idea with I guess the globalization of standards led by the IAIS. Now in Latin America, there's an entity called ASAL, which is the Association of Insurance Supervisors of America Latina, right? ASAL. And they also have meetings regularly, and SUSEP is also represented there, and there's much exchange of information, and countries are catching up very fast. Some people think, well, Solvency II is the perfect world. No, Solvency II also has its problems. It's in principle is a very good concept, but it has some operational problems that we are going to discuss later on. The message is that everybody is trying to modernize the way the solvency is calculated. Everybody talks about the spirit of protecting the consumer, the policyholder, but regulation has two pieces. One is solvency, and the other is the so-called market conduct. And what is market conduct? Well, you're selling a product that is very difficult to understand, right? So you are at the policyholder or the consumer is at a disadvantage because he or she may not understand fully the benefits of the insurance contract. So that's why insurance is sold through agents, through a sales force, through brokers, to explain to the client what the insurance policy is all about. And even in very advanced markets like Switzerland, the average individual doesn't know anything about insurance. It's basically a phenomenon that the contract issuer knows more, and this is called in economics a lemon problem. Somebody knows much better how a contract works than the other party, and this creates imbalances. So that's why the regulators are concerned with market conduct. And market conduct means that if you have an insurance policy, you have first to go to the superintendent of insurance to have it authorized. In many countries, that's I don't know if in Brazil that's the case, but I assume that you have to send your before selling policies, you have to send your exactly to the technical documents to the superintendent for approval. Okay, so that's universal. Okay, Then here's the IAIS, International Association of Insurance Supervisors. So G20, Financial Stability Board, IAIS, and IAIS called the Actuaries. The Actuaries is the IAA, International Actuarial Association, okay? And the International Actuarial Association is the association of all insurance associations in the world. The IBA is, of course, represented there. And this is where I took the number of 75,000 members of the International Actuarial Association. The last World Congress was in Berlin last year. When was that? Last year? Yeah, last year. And I don't know if anybody was there, but there were actuaries from 103 countries. It was very, very big and very exciting to get to know actuaries from faraway places, and it was a very, very good event. And the topics discussed were similar: Solvency II, IFRS 17, etc. Okay, so this is only to tell that the IAIS basically relied on the International Actuarial Association to develop capital requirements. And basically this is the idea, right? So the financial position, you have some technical provisions and other liabilities, and technical provisions is the word being used in Europe for reserves. For some reason, they call it technical provisions, okay? So you have technical provisions and other liabilities on the one hand, and then you have capital resources, okay? Now, if we look at capital requirements, you have the so-called best estimate liabilities, BEL, best estimate liabilities. You have other liabilities as well. You have a risk margin and a capital requirement. And here's the idea: to have a minimum requirement and then a prescribed requirement. The prescribed requirement is called the SCR, Solvency Capital Requirement. Okay, but then also you have a minimum. And then, as I told you, if you are below the minimum, then you have intervention in your company. So the insurance regulator is basically takes over the management of your company and liquidates or organizes the runoff of the liabilities. Mm-hmm. Okay. Now, how can I model a capital requirement? Well, let's say that we have X, which is a random variable that represents the market value of the capital, and then I have Y, which is is also a random variable, which is represents the assets that support the market value of capital. Then we define the expected value well, we have Z, which is a function of these two things. And then the solvency capital requirement is a function of Z minus the expected value. All right, and this is what I called in one other slide the shifted metric, right? So FZ is commonly a risk metric. For example, VAR or T-VAR, etc. Okay, so here we have a distribution that is skewed to the basically skewed to the right. Okay, it depends the sign of what we're trying to model, but here we have 2 points. The first one would be the value at risk, and the other would be the T value at risk. So the T value at risk is the integral from the value at risk till infinity. Okay, and these both the value at risk and the T value at risk are called characteristics of the distribution. Okay, so here are the T value and the T value at risk and value at risk. So this is how the modeling is normally done, and this is basically prescribed by the International Actuarial Association and also the International Association of Insurance Supervisors. They basically, for actual matters, they go to the International Actuarial Association. Okay. Now, here's the rest of the story. So we have the function, okay, and then we have the so the y what was y? Y it was a random variable representing the assets that back up the capital. So y is identical to the market value of capital, right? And there's the distribution, and then you have some form of a curve, some form of a distribution, and then you take up the the characteristics as appropriate. So in this case, you have the dotted line the dotted line here representing the metric. So f set is a function. This could be any quantile measure, characteristic of the distribution, t-var, var, whatever you want it to be. Okay, so that's the concept. And then I have here the shifted calculation. So this is, remember the concept that risk is deviation from the expected. Okay, that's the concept. Deviation from the expected. So I capture basically this distance between this and presumably the present expected value measure. Mm-hmm. Now, why Solvency II? What was the idea behind it? What was wrong with Solvency I? Well, they wanted to facilitate the development of the European Union, the insurance market of the European Union. This was, in the long time ago. So this was well before the financial crisis and the euro crisis and all the crises that Europe has faced. Now the crisis of today is the political crisis. There's also a sort of crisis, but I think the idea was to harmonize the markets, because Europe is it's not like Brazil. Brazil is immense territory. You fly many hours and you're still in Brazil, right? in Europe, you drive a few hours and you're in a different country. You're in 3 countries in 2 hours, right? It's so small, and it's so small that the Zurich airport, where I live, the Zurich airport has all flights are international. There's no. So that's the size of Switzerland. All flights, when you go to an airport and all flights are international, that means that you live in a very small country, right? Here you have, I don't know, 90% of the flights are local. I don't know. There's a lot. Even you have an airport. Congonhas is local airport. Yeah. Even you have an airport for local, right? Anyway, but that means that there's a lot of countries. And each country has its own rules and regulations and everything. So the European regulator says, no, let's have the same rules. So, for example, the plugs in Europe are the same everywhere. They used to be different, but now they are the same, except in the UK. The UK still keeps this very strange plug. And Switzerland not being part of the European Union, has its own plug. But then they created very strange rules. For example, the cucumber, they cannot be curved, they have to be straight, these kind of rules. There's a lot of bureaucracy, okay? So in insurance, they say, well, let's play with the same rules, because also companies have, they conduct business in many countries, not only in one country, but in many countries, right? Of course, I mentioned AXA or Allianz as examples of companies conducting business in many countries, in more than 150 countries, right? But the typical European insurance company sells policies in many jurisdictions, so they wanted to have this harmonic market. Who must comply? Everybody, except if your gross written premium is less than 5 million euro. Okay, and euro is a little bit more than dollar, right? So if you're relatively small, you don't comply. Now, what changes with respect to previous directives? And directive is, they call it direct. It's really a law, but they call it directive. Now, Solvency I was made up of several directives or several laws. A collection of laws, and then Solvency II replaces everything with one single law called the Solvency II Directive, and basically they introduce economic risk-based solvency requirement. So economic means that everything is mark to market. So the assets are the market value of the assets, the liabilities is the fair value of the liabilities. Then quantitative requirements over and above the technical provisions. Then something called ORSA, which is the own risk and solvency assessment. So the companies have to, every year, they have to submit a report to assess their own solvency situation to the regulator. And we are going to see examples of this report. Then the SRP, which is the supervisory review process. So better and earlier identification of insurers with potential difficulties, and the establishment of 4 functions, which are called the internal functions of the company. So these 4 functions are the actuarial function, the risk management function, the audit function, and the internal control function. They should have these functions, all right? All companies, all right? Most of them will have them, right? But since Solvency II was enacted, everybody must have basically play with the same rules, under the same rules. So this is kind of a picture of the Solvency II world. Then we have the framework. Here we have the 3 pillars, and this pillar idea comes from the Basel Accords. So pillar 1 means quantitative requirements. What's quantitative? Mathematics, basically, mathematics, okay? Then pillar 2 is corporate governance and ORSA. So corporate governance is what are the attributions, the responsibilities of the they call it the management or supervisory board of the company. So what management is supposed to be doing, what is management responsible for, etc. And pillar 3, it's about disclosure and transparency. So disclosure and transparency is what kind of information I need to make available to the public, right? And what type of information I need to give to the insurance regulator, okay? So overall, there's the system of governance. So this is the most important part, system of governance, how the business should be conducted, how the business should be controlled, audited, managed, etc. And concepts like strategy and risk appetite, management and monitoring, and then reporting and disclosure. There's also on the right-hand side risks, the main risks, which are the insurance risk, okay, that has to be measured, the market risk, the liquidity risk, the credit risk, and the operational risks. So all these risks have to be measured. Then you have something called the use test. So what is the use test? The use test is that if you decide not to follow the standard formula, in other words, if you decide to have an internal model, then you need to prove that the internal, and what is a model? A model is a set of formulas, it's a set of procedures and formulas, and maybe some computer code, which is the implementation of the model, right? Everything is documented, and you have all the protocols, where the information comes from, etc. So it's like all the rules to measure the solvency capital position. So if you adopt an internal model, first you have to ask for authorization to the supervisor. So the supervisor looks at the model, and then they may challenge you, or they may say, yeah, it's okay, or change it, change this, change that, etc. So, but then let's assume that the model is approved. Then you have to pass the so-called use test. So you develop the model, you have to prove that you're using it for your strategic and business decisions, and that's very difficult. How would you prove that the top management is relying on the model? That's a difficult story, right? And then it changes depending on the jurisdiction. For example, Ireland is very strict. In Ireland, if there's a board meeting, right? How is it called here? La Junta Directiva or something? Board. Conselho. No? So if there's a board meeting, right? They have to basically to send the meeting minutes to the supervisor, and then they have to say, Mr. Smith, for example, said this or said that regarding risk. So they control what type of comments they say, what type of participation they have, and the regulator looks at that. So they say, well, in the board, you should have people who is knowledgeable about risk. You cannot just have business people. You need to have people who know about risk, which means that that the board members have to be trained in or have to understand risk. They don't have to be experts. They are not experts in risk management or in risk assessment, but they should be familiar with what the technical people are doing, and this is a legal requirement. So that's the use test. And then you have some other processes like outsourcing, information systems, reinsurance, etc., that are also part and are documented in the Solvency II. Right? The last part is the internal control, and the internal control is what are the procedures, what are the processes to control that the company is well managed, okay? So that there's no, that the risk of operational failure is mitigated, that everything works as expected. So this is the internal control process. And it's very, in a way, what we do is very, in terms of processes and in terms of information, it's very complex. So running an insurance company is a complex thing to do. I imagine is much more complex than any other type of business, say for, I don't know, IT businesses or things like that, which should also be very, very complex. But our industry is by its nature complicated and it's expensive. We are not yet at the point where we can offer products that are more affordable to consumers because everything that we do is relatively complex, and this is the nature of the business. Okay, so this would be the framework, the 3 pillars. And what happened in Europe is that all companies invested a lot of time in Pillar 1, the quantitative requirements, the formulas. So they think that this is the most important thing, whereas it's an important aspect, but not necessarily the most important. So equally important is the qualitative requirements, the corporate governance, etc., and also the disclosure and transparency and reporting. So people think that Solvency II is about formulas. Well, that's mathematics. That's relatively easy or relatively straightforward. What's more important is everything that should go inside the company and how the functions need to be organized and so on and so forth. Okay. Any question here? Okay. Now let's look at the different views of capital. Now we have here on the right-hand side the so-called statutory view of capital, right? Or statutory balance sheet, if you want. And then on the right-hand side we have the so-called economic balance sheet. What's the difference between statutory and economic? Well, it depends where you are, but basically statutory is what the insurance superintendent is asking you to do, right? So, and it depends. Some insurance regulators tell you how to do the accounting. Some others say, well, use these type of rules, etc. Examples: Swiss regulator, they tell you you can use US GAAP, if you want. You can use IFRS 4 or now IFRS 17 if you want, or you can use something called Swiss FAIR, which is the Swiss accounting standard. So any of the three you can use. This is what the regulator tells you. So these standards have been developed not by the regulator, but by external bodies, right? Now, in some other countries, for example, United States, the regulator tells you how to do the statutory accounting. So they tell you how to do the reserves, how to do the deferred acquisition costs, etc., right? Statutory accounting. And yesterday I also mentioned that you have also to comply with US GAAP. So you have one set of statements for regulation, okay, for insurance regulation. You have a second set of statements for financial reporting, and these are for the shareholders of the company or the investors of the company. And you have a third set of statements for the tax authority, right? Because the tax authority want they want to have reserves that are not so big, because if you have big reserves, you defer profit recognition. And if you defer profit recognition, the tax collector collects less money, right? As contrast, the insurance supervisor wants higher reserves, because higher reserves means more safety for the policyholders. Okay, so you may have as many as 3 sets of statements that you have to publish. But then statements is just a view of the business. Okay, so there are different ways, different philosophies of how to view the business. So we have here the so-called statutory balance sheet, what normally the regulator will tell you to do, where you have statutory assets, and then they will tell you what assets can be admitted and what assets cannot be admitted. For example, I know a company in Europe, a very old company that had assets. They have works of art as part of the assets. They have oriental carpets as part of the assets, art collection, yeah. And the regulator said, well, how much these assets are worth? Well, they were worth, I don't know, 50 million, for example. And the regulator says, no, we cannot admit these assets, because if you have to pay claims, are you going to sell these assets? And if you sell them, what's the price you are going to get? So this is very uncertain. So this company had to sell all the works of art, and I was able to buy oriental carpet, a very low price, which was a Persian carpet, very old, from the 19th century, hand made, right? And I think I pay something like $100 or something for a very nice carpet, right? So, and that was because the regulator didn't accept that. So you have the statutory assets, statutory liabilities, which is basically the reserves, right? And statutory capital, right? And then you have something called capitalization value, right? So capitalization value is basically the market value of the company. So if you multiply the number of outstanding shares times the value per share, or the price per share, that's the capitalization value, which is true if the company is publicly listed, right? If you can buy shares of that company in a stock exchange. If a company belongs to a family or to an individual, then that's a different story, right? Then on the right-hand side, we have a US GAAP view or an IFRS 4, IFRS 17 view of the world, or also Solvency II view of the world. So on the left-hand side, we have the statutory view. On the right-hand side, we have the modern view, okay? So you will have, instead of statutory assets, what the regulator tells you, you will have the market value of assets. And the market value of assets is Today, what's the value of these of the assets that I'm holding? Now, the assets that we hold are typically investments. We don't have factories. Insurance companies don't have factories, don't have machinery. What do we have as assets? Furniture, computers, and this is worth nothing, right? The cost is relatively very low. But if we were a manufacturing company, we would buy a machine that cost, 100 million, whatever. So that's a fixed asset of a different nature. Our assets are, what do we have? Paper, I don't know. These are our assets, right? So most of our assets in the balance sheet are invested assets. This is, you look at your balance sheet, most of the assets are invested assets, okay? Okay, perhaps we own the building, okay, that's an asset as well, etc., right? So we have here the view, the economic view, and this is called own funds, and this is called best estimate liabilities. And this economic concept is also consistent with what we have been doing, taking the present value of cash flows, right? Because the 5%, okay, we used a 5% rate, whatever, but theoretically, this 5% is kind of a market rate that is adjusted to the characteristics of the contract. So it's the market view. So I have, in the estimate of the present value of cash flows, I have a market view embedded, right? And then we have something like solvency capital, excess capital, and then franchise value, okay? So franchise value is the value, basically value of the business. One way to explain what is franchise value is think of a company, what's a good example? Coca-Cola, right? Coca-Cola is a very good example because what they sell is water with sugar and artificial color. So what's the price of that? It's close to zero, right? It's close to zero. So why you pay 100 times the cost of this, right? Because Coca-Cola invests in the brand, right? In the brand. So Coca-Cola for many years was the top brand in the world, the most recognized brand in the world, because they invest millions in marketing. So if tomorrow you start selling a beverage that is water with sugar and artificial color, you are not going to sell much business because your name is not Coca-Cola, right? So Coca-Cola is worth a lot of money because of the brand, because everybody in the world knows the brand Coca-Cola. Used to be the best brand or the most recognized brand in the world. Today, I think used to be Apple. I think WhatsApp is now no. I'm talking about Mexico. In Mexico, the number one brand is WhatsApp. Everybody knows WhatsApp. Or most people know WhatsApp, even though Mexico is the number one consumer of Coca-Cola in the world. Did you know that? Yeah. Mexicans drink a lot of Coca-Cola for whatever reason. Okay, so that is the franchise value. By the same token, if your name is at random, I'm going to say Bradesco, but I could have said any company. It's a recognized company, right? So it has some franchise value because it's a company that's been there for many years, big company, and so on and so forth. Okay, so that would be, and then we have two arrows here, and the arrows means that these two things are converging, so they are becoming similar. I mentioned before one of the problems of the Mexican solvency. And the Mexican solvency is that the regulator tells you, if you do your Solvency II, that's your balance sheet that's the balance sheet that you need to use. And what's wrong with that? Well, in my view, Solvency II is to measure capital, to measure solvency capital. And IFRS 17 is to measure performance. So these are two different things. But the Mexican regulator has not taken any position And for now, companies don't know what to do. They are doing the balance sheet according to the Solvency II rules and not the IFRS rules. And this is something is going to explode at some point because Mexico, of course, complies with IFRS, right? So it's uncertain at this moment, and the regulator thought, well, do your Solvency II, and that's valid also for reporting purposes, which is not necessarily the same thing. Okay, now this is how the balance sheet of Solvency II looks like, which is very looks a bit complex. First, we have assets. So everything here in blue is assets. Okay. So we have, first of all, this part here are the assets. If you can read, are the assets covering the technical provisions. Again, technical provisions is another word for reserves. The SCR, Solvency Capital Requirement, and the MCR, Minimum Capital Requirement. So this blue piece here are the assets covering these three things. Okay. Then we have, before we talk about the other elements, let's look at the liability side. We have in orange the so-called technical provisions here, technical provisions in orange. But we have different shapes of orange, right? We have dark orange here, which is this is the dark orange is the market consistent valuation for hedgeable risks. Now, in hedgeable, there's no translation in Spanish, and I'm almost sure that there's no translation in Portuguese. But hedgeable means risk that can be insured, right? So to hedge something is a synonym. There's a synonym between hedging and insuring, right? Or covering. To hedge is to cover something, right? So some risks can be covered, okay? Basically, if I have some liabilities, I can buy an instrument, a financial instrument that covers this risk. So this is hedging. And perfect hedging is if the financial instrument has cash flows that are similar to the cash flows of the liability. So that's a perfect hedge. But the bad news is that insurance risks are generally non-hedgeable, right? Because I cannot buy an instrument in the financial markets that replicates the insurance liability. So I have a problem there. So I call that non-hedgeable. And non-hedgeable is made of two parts. BEL, best estimate liability, which is this light orange area, and something called risk margin, okay? So if I have a liability, if I can buy something that replicates or covers or hedges this liability, then this is called a hedgeable risk. If not, for example, if I have insurance contracts and I cannot buy any financial instrument that is going to hedge or cover or replicate the cash flows, then I do BEL, best estimate liability, but then I add a risk margin to be covered, to be on the safe side. Okay, so these are the orange is technical provisions. Then on top of technical provisions, I have a green box, and then this green box is the minimum capital requirement. And then on top of the minimum capital requirement, I have the solvency capital requirement, okay? And all these boxes are covered by the assets covering technical provisions, MCR and SCR. Now, there's something called own funds, in Spanish, fondos propios, right? Own funds. And these own funds cover basically the capital minimum and solvency capital requirement, and then has a surplus, right? And this is called, this area right here is called ancillary own funds. So these are like think of it as a surplus capital that I have. So this part is the basic, and this part is ancillary. And there are rules to determine which is which, okay? So this is the balance sheet, and this is a diagram. Looks a bit complicated, but it's not that complicated. I think the thing that makes it a bit complicated is when we do the reporting, that we have to identify all these terms, and also we should be able to calculate each of these entries, right? So this is a balance sheet, and is there an income statement of Solvency II? Well, not really. You can construct one, but actually basically what you need to have is this balance sheet. Now, this balance sheet is not the balance sheet that is used for reporting, except, of course, if you're in Mexico, which anomalously is the same thing, right? But shouldn't be the same. So one thing is your solvency, the other is the IFRS 17. But I would be interested in following SUSEP to see what they are going to do in terms of financial reporting and reporting to the regulator. If everything goes well, I think they are going to tell you to do IFRS 17. Any comment on that? Okay. All right. So this is one of the most important slides. Is one that is that also you if you want to print it out in color and put it in your living room or your bedroom. No, in your bedroom. Don't put it in your bedroom because your spouse will mistrust you. But anyway, I think I like it because it explains the concept of stressing the balance sheet or shocking the balance sheet. So suppose that under normal conditions, no major claims, all the claims are normal, nothing happens, no big claims, right? So these are the normal conditions. You have your market value of assets, and then you have your fair value of liabilities plus the own funds, okay, under normal conditions. So look at the size of the own funds, okay, it's here. But then what happens under stress conditions, okay? So what you do, as a matter of fact, is that you stress the balance sheet. So what's the meaning of stressing the balance sheet? You simulate that many bad things are going to happen, okay? So this is a stress. You put the balance sheet under stress. And if you put the balance sheet under stress, your market value of assets goes down. And if your market value of assets goes down, also your liabilities and your equity or capital should go down because it's called a balance sheet. It should balance, okay? So this is, you run an experiment. So this is your normal condition. You stress the condition and then look at the box. Own funds, look at the box. So basically this difference here is called the solvency capital requirement. If you understand this slide, you basically understand the concept of Solvency II, right? Not everything, but it's a good slide because this is something that you can tell your boss, your manager. This is the idea behind Solvency II, stressing the balance sheet, so simulating that many bad things are going to happen, assets are going to go down, and so will the own funds. Okay, and the difference between the normal and the stressed is going to be called the solvency capital requirement. Okay. All right. Now, what about risk aggregation? Okay. What is this concept with risk aggregation? Okay, we said before that we have different types of risks. For example, the market risk, which we're going to talk more about that. Market risk is, for now, we say that this is the risk that my balance sheet is going to change because there will be changes in macroeconomic variables. Okay. So I have investments and these in my assets, right, in my balance sheet, and these investments Well, these investments earn certain interest rate, okay? Tasa de, ¿cómo se dice? Tasa de juros. Huh? Certain interest rate. And these interest rates are basically, these are outside of my control. These are the interest rates that the assets pay, right? If I buy a bond, I will receive certain interest, right? Or if I buy commercial paper, or if I buy shares of stock, etc. And one actor here in the movement of interest rates is, of course, the central bank, right? Because also I can buy government bonds, right? And government bonds are relatively safe because the government has a very large capacity to pay. Why is that? Because the government controls who pays taxes and how much taxes should be paid. So they have infinite capacity of paying, right? So theoretically, the government bond is risk-free, at least theoretically. We know that governments can go can be in a very bad shape. So if you try to buy government bonds from I don't know, for example, Argentina is going through a difficult period this time. So the government bond is paying more because there's more risk. So the higher the risk, the higher the return, right? If you buy a government bond of Switzerland, they pay you almost nothing, right? Because it's relatively safe at this time. This doesn't mean that Argentina is going to stay like that, or Switzerland is going to stay like that. Things change, and anything can happen. So the market risk is the risk that there will be changes in my balance sheet simply because there are changes in macroeconomic variables that will affect the value of my investments. So that's market risk. Then credit risk. What is credit risk? Well, credit risk is also called counterparty risk or default risk. Actually, Solvency II calls it default risk. And that is that if I buy, for example, if I buy a bond, the issuer of this bond may pay me or maybe not, right? Because if I buy a bond, say for example, I mentioned Coca-Cola before, I buy a bond from Coca-Cola, Coca-Cola may be able to pay me or maybe not. Because if Coca-Cola goes bad, then they will not have funds to pay me. So there's risk, okay? So that's called credit risk, right? Coca-Cola is a safe investment, I think, but you get the point. Also, if I reinsure business, the reinsurance company may pay me or maybe not, right? Because if the reinsurance company gets into financial troubles, they will not be able to pay me. So even if I'm giving some portion of the risk, of the insurance risk, to the reinsurance company, I still have credit risk, right? Then what is operational? Well, operational are everything that has to do with risks in the operation. So there could be system failures, right? There could be software malfunctioning. There could be human error. Okay. So, for example, in a bank, the clerk may or the cashier may make a mistake, and then the bank loses money, right? So that's a human error. Or there could be fraud, right? So the policyholder may commit fraud, and this is very, very common in insurance. We have to spend a lot of money to adjudicate the claim and also to make sure that there is no fraud. But fraud is something that is very common in insurance, right? You know the story. I know of a tremendous case, and this happened in Germany. In Germany, there was a medical doctor who cut his fingers to claim disability benefits, because doctor without fingers cannot operate, cannot practice any longer, right? So he claimed disability benefits from the insurance company. But then the insurance company investigated the incident, right? And the cut was very, the doctor claimed that it was he was chopping wood and it was an accident, right? While he was chopping wood. But then what they discovered was that the cut was very clean cut, very clean, done by in a surgical procedure, very, very clean cut. So what in reality happened was that the doctor cut his own fingers, very, very clean cut, to claim disability benefits, okay? Now, what happened is that the insurance company didn't pay, right? Because it was fraud. Then the doctor went to jail, and then the doctor lost his medical license, could not practice any longer, and last but not least, he lost 4 fingers for nothing, right? So it was a horrible case, but this is the extent. The way people go that far to commit fraud to get the disability. In this case, it was a disability policy paying lifetime pension, right? So the doctor could not practice any longer, and the insurance company had to pay, right? So, and this is, I'm talking about a relatively advanced market, so it could happen anywhere. And this is part of operational risk as well. Now, some things like management decisions, if the manager is very stupid, well, that's a risk that he or she will make a very bad decision. Unfortunately, I cannot do anything against that, right? I cannot calculate the probability that he's going to make a bad decision. That's impossible, right? Also, the risk that an employee steals from you. So you have to be aware that the fraud can be committed by an external person, or it can be committed also by internal person. Very difficult to deal with that. Then we have, well, here we say non-life underwriting risk, okay? So, which basically is composed of 3 risks, the so-called premium risk, reserve risk, and catastrophe risk. And then the life underwriting risk, which basically, but not only, is mortality, right? Mortality, longevity, persistency, etc., right? Also catastrophe risk and so on. So you have, in this case, we would apply the same logic, the same principle of constructing probability distributions. So each one of these things, each one of these curves is a probability distribution, and I could have, basically have a risk metric for these distributions, or better yet, I can aggregate everything into one big distribution, and this is called aggregated risk. And the idea is that to the extent that it is possible, I work with the aggregated distribution, which considers all the risks that I'm measuring, okay? Again, there are many risks. There are risks that are impossible to evaluate. For example, a risk that is tremendous and cannot be evaluated is political risk, okay? So if the president decides or the Congress decides a new set of rules, this can impact my business tremendously. It's political risk. There's nothing I can do about it. I cannot plan for it. I cannot measure it, etc. Right? If there's an IFRS 17 requirement, is that per se a risk? Well, could be, because you have to change a lot of things. You have to incur a lot of expenses to implement the new reporting system. Okay, and you have to do it, right? You have to do it, and that's it. So things like that are difficult. Another thing, another risk that is not measurable is so-called reputational risk. Reputational risk is the risk that you do something, I don't know, you decline a big claim that has to be paid, and your company starts losing business because nobody trusts your company any longer. So the value of the business goes down. You sell fewer and fewer policies because of reputational problems. So that's difficult, right? Cannot be measured. So all the risks, and we are going to explore that later in more detail, can be evaluated, but not everything. All right. Now, this is also a chart that is interesting. This is the way Solvency II standard formula classifies risks. Okay. And then again, I mentioned again the standard according to the standard formula. So you have on top SCR, Solvency Capital Requirement. Okay, Solvency Capital Requirement. Then you have below that BSCR, which is Basic Solvency Capital Requirement. There's an extra B, that means Basic Solvency Capital Requirement. Then you have to the right and to the left, you have adjustments, and then you have OP, which is operational risk. Okay, so you have to measure that, and then you have basically six boxes below that. There are the different risks. So you have we start with the market risk. Okay, we define briefly what was that, but the market risk has several soft modules or sub risks. For example, interest rate risk, the risk that interest rates in the market change and then I have an impact in my balance sheet. Or equity risk, the risk that there are changes in the price of equities or shares of stock, and then I have a risk in my balance sheet. Or the property risk, if I invest in real estate and property prices go down, then I have an impact. Or spread risk, these are spreads over risk-free rates. Or currency. Now, currency risk is relevant if I have business denominated in different currencies. Okay, so for example, if I issue policies in reais, but also I issue policies in pesos in another country, then I have exchange risk. Okay. Then I have concentration risk, and this is the risk of a lot of concentration. In other words, all the eggs in the same basket. Okay. And then I have something called illiquidity risk. So this is the risk of becoming illiquid, all right, of not having enough money to pay claims or to pay for your operations, in which case you have to sell assets or you have to ask for a credit line, whatever, which is very expensive. Then you have, first of all, let's talk about one without any dependencies, which is the default risk. This is also the credit risk. And then intangibles, let's talk about this later on. Then you have the insurance risks, which are health, life, and non-life, right? Now, health has a lot of boxes, so I'm saving this for last. I start with non-life. Non-life, you have premium risk, it's called premium and reserve risk. Now, what is premium and reserve risk? This is made of two risks. The risk that the premium is insufficient. For example, I calculated the premium to be 15,000 and then it was insufficient. So that's a risk. And reserve risk. What's reserve risk? Well, if I have a reserve, the risk that the reserve is insufficient. Okay. Then I have something called lapse risk. Okay. And this is the risk that my technical provisions, my reserves, are going to change because in the calculation of the reserves, I may consider future inflows. and then the contracts were canceled. So that's a lapse risk. Very strange in many countries, but that's also something that is considered in non-life. And then cat risk. Cat here is not an animal, not a pet. It's a catastrophe risk. Catastrophe risk. Now, catastrophe could be man-made, right? So if there's an explosion in a factory, it's man-made. This is considered man-made. Maybe there was bad maintenance and the factory exploded, so man-made. Or could be sabotage, or could be any of these things. A terrorist attack is man-made catastrophe. Or if there's a fire, well, the fire is an accident. I'm not talking about arson. I'm talking about something. I don't know. There was a short circuit, and then this created a fire. This is considered man-made, right? And also there's natural catastrophes. And natural catastrophes are things like earthquake, hurricane, things like that, flooding, things like that. Then moving on to the life. In the life we have mortality risk, longevity, disability, morbidity, lapse, expenses. Expenses, for example, is that the expenses that I calculated are not sufficient to cover my actual costs. Revision, and revision is that there's some changes in regulation that I have to pay higher amounts as expected. And then CAT, but the CAT in life is not the same as CAT in non-life. CAT in life means generally 3 or more deaths in the same event. So if there's a car crash and 3 of your policyholders are traveling in this car, this typically happens in a bus accident. Okay, so the same group, say for example, a company goes by bus to I don't know, to another city, and then there in the highway there's an accident, and at least 3 people die. That's considered a catastrophe. So has nothing to do with natural catastrophe, but 3 people dying in the same event. And even many insurers say, well, it's considered a CAT event if people died in the same event in a window of 24 hours, because probably this was an accident and one person died right away in the accident, but then the other 2 were hospitalized and they died within a few hours. So that's considered the same event. But in another scenario, one person died and then the other 2 went to the hospital, but then 15 days later they walk out of the hospital. So this is not considered a CAT in life. And then for CAT business, usually there's reinsurance, because this is very rare that 3 or more people of your 3 or more policyholders died. It's a bit strange, but it happens, particularly because you have seen all these stories. Actually, there was a accident with a football team, right? Yeah. Okay. This was a flight. Okay. Goal, or which was a? Okay. Yeah. So that would be. I don't know if these people were insured or not, but this would be an example, because groups tend to travel together, right? Also, many years ago, I don't know if you remember, there was a crash and all the government of Poland were traveling in the same flight, right? So the president, which is the brother of the current president, Kaczynski, the brother died, right? And the twin brother is now the president. But anyway, many ministers and the president were traveling in the same flight, and the plane crashed, and everybody died. So no government. I hope this doesn't happen in other countries. Right? Okay, so yeah, so this would be an example of CAT. Now, for health we have something here that it says SLT or non-SLT. The idea is that health could be treated as life or as general insurance, depending on many factors. Now, technically, health looks, what do you think, looks more than life or looks more like general insurance? General. Yeah. So if that's the case, then you adopt this non-SLT. SLT means similar to life techniques. So health non-similar to life techniques or health similar to life techniques. That's the idea. And then it depends on the nature of the products. And also well, here you have the point of having a different entity for health, for salud, no? The ANS. Yeah? In most other countries, there's only one supervisor, right? But and also I know, for example, in the United States, general company can issue health contracts, or life company can issue health contracts. So they decide. Of course, you have to have a health license, but if you're a general contract, you can apply for a health license. If you are a life company, you can also apply for health license. So technically, I would say that health looks a bit more than to general insurance than to non-general insurance, but it depends, because health contracts can be very, very tricky to classify. Okay, there are all sorts of contracts, and some contracts are complementary to social or supplement social security. Some other contracts are hospital cash payments. Some other contracts cover only hospitalizations. It depends. It's health contracts are very different in different parts of the world. Okay, so if it is treated like non-life, this looks similar to that, except that there's no cat. If it is treated like life, this looks similar to that. Okay. So these are all the different risks in the standard formula, and each of these has I don't know, formulas, theory behind it. It's very, very long. We are going to see probably tomorrow. We are going to see tomorrow we will see examples of some of these modules, and how they are calculated under the standard formula. But also we're going to offer some other ideas into the construction of solvency models. Okay. All right. Any questions here? Okay, I think we are well. There's only a few minutes. There's a question.
Hi. When you spoke about the scenario of stress about solvency. Yeah. You say that this one. You say that the market value under stress goes down, and also our own funds.
Yes.
But the liability tends to goes down as well, or I have to consider exactly the amount of liabilities that I have under normal conditions.
No. Well, the thing here is that in the balance sheet, if the assets go down, you have to go down on the liabilities or capital necessarily, because the balance sheet always has to balance. That's why it's called balance sheet, no? So here we say that basically which box is from which box I take money, right? If the market value of assets goes down, I can take money from from the own funds or from the liabilities or from both. The question is, from where I take money? Well, I have to do it depends. I have to look at my accounts and see which accounts are supported by either by capital or by liabilities. And here, own funds is another word for capital. Think of it as capital, or in Spanish we say patrimonio. No? This is the patrimonio. So it depends. The source of you always have in accounting. You always have you debit something and you credit it against another thing, right? Or you can have multiple. You can have one debit and more than one credit, or vice versa. But you always identify which accounts go up or down. And if there's a stress in market conditions, in market value of assets, then you will have to know exactly where the money is has to be taken from. Yeah, that's a good question. Yeah. Anything else? If not, if there's any other question, ask it now. If not, tomorrow you can also ask me tomorrow. But I propose that we finish at this point because there's only less than 10 minutes left, and it's probably best if we stop now that we have finished this presentation. Unless you want to stay a few minutes, but maybe we go now and we continue tomorrow, if that's okay with you. Yeah. Okay. All right. So thank you so much, and see you tomorrow.
Pessoal, rapidamente um aviso. Alguém perdeu uma pulseirinha de prata? Se alguém der falta, tá com a Aninha lá na recepção, tá? E a gente espera vocês aqui amanhã às 9 horas. Obrigada pela participação de vocês até agora. E para aqueles motivados que chegarem aqui bem cedinho amanhã, para a gente começar, tem um brinde aqui para vocês. Os 30 primeiros que chegarem tem um brinde esperando vocês.